Let's talk business now, and the Monetary Policy Committee will retain the central bank rate at 8.7% to ensure that inflation expectations remain anchored within the target range and the exchange rate remains stable. The MPC noted that there is no need to continue monitoring the evolution of global oil prices and any second-round effects on inflation, as well as other developments in the global and domestic economies. NTV's Brian George reports.
Kenyans have been insulated from expensive loans as the Monetary Policy Committee retains lending rates, much against the wish of Kenyan banks.
Besides inflation fears, Kenya Bankers Association had predicted a slow economic growth into 2026, which could consequently put pressure on businesses from an operational cost point of view and pressure on households from a cost of living point of view, which is why they were calling for a review of these interest rates.
In a research note released on 3rd June, the Kenyan Bankers Association, KBA, argued that a modest increase in the CBR is necessary to contain the rising inflationary pressures. Kenya's overall inflation increased to 6.7% in May 2026, from 5.6% in April due to high energy prices arising from the elevated global oil prices, but remained within the target range of 5 and 2.5%. Core inflation rose to 3.2% in May from 2.8% in April, mainly driven by high inflation for transport items arising from high fuel prices. The banking sector remains stable and resilient with strong liquidity and capital adequacy ratios. The ratio of gross non-performing loans, or NPLs, to gross loans stood at 15.3% in May 2026. Down from 15.6% in February 2026 and 17.6% in August 2025. Decreases in the NPLs were noted in the personal and household, transport and communication, and mining and quarrying services. Banks have continued to make adequate provisions for the NPLs. The committee will meet again in August 2026.
From a macroeconomic point of view, June's MPC comes at an interesting time. Renewed global pressures on global oil prices and the volatility around treasury yields are some of the factors that were driving CBK's reevaluation of this rate. Brian George, Otieno, NTV, Nairobi.